So what are the consequences of being a control group? Basically, as mentioned earlier, the control group is treated as a single entity, a single employer for various qualification purposes under the Internal Revenue Code. Terms of plan documents may automatically include or exclude certain members of the control group, but it's tested as a single employer for the ADP and ACP testing purposes and for coverage testing purposes that 80% of the group has to be covered. That's where it becomes difficult in eliminating some of these entities and trying to avoid being considered a control group. Service with all members of control group counts for eligibility and investing purposes. And transferring from one member to another control group is not considered a distributable event. So under the action items, confirm the plan document reflects intended inclusion or exclusion of employees of control group members. It should stipulate other firms that are either included based on ownership or excluded based on ownership from the plan. Very important consideration. The second action step is to inform the plan's record keeper or TPA of controlled group members or combined group members, because they need to do special accounting there and they need to combine testing, assuming there are separate record keeper entities for each of these groups, which there may be, and it's allowable, but it gets complicated and more costly because one entity has to combine all of the testing for each entity that uses a different third-party record keeper. Exceptions to the control group treatment. One exception is affectionately called the Q SLOB, which is the qualified separate lines of business. So let's talk about that for a minute. There are members of control groups, but they may be treated as different employers. There are certain requirements in order to be considered eligible for the Q SLOB treatment. In other words, not to be considered a control group. The Q SLOB has 50 or more employees. The sponsor files 5310-A with the IRS, notifying them that they are applying for Q SLOB rules. And they have to pass the administrative scrutiny of the regulators. And the Q SLOB can satisfy this administrative scrutiny under a safe harbor regulation or by special IRS determination. The LOB of Q SLOB stands for lines of business, and these are reasonable. They have to have substantial differences in terms of the products or services, and the products or services serve or are manufactured in or prepared in different geographic regions. There's a geographic determination and a product or services determination. They also have different levels in the chain of distribution. They could have a wholesale or a distribution of retail distribution. So these are the things that go into defining whether it's a Q SLOB or not. Also, different types of transactions. One may be a leasing organization, one may sell a product. And certainly important is different intended customers. And the disparity might be as simplistic as one entity deals with the public and one entity deals with the government entities. So these are all the things that go into making a determination of Q SLOB. Also, the lines of business must be formally organized as a separate unit, whether it be a corporation, partnership, division, etc. They must be separate profit centers, so to have a separate workforce and a separate management as well. The action step here is obviously consult legal counsel to explore whether the plan can take advantage of Q SLOB rules, regulations, and disaggregate with a potential control group for testing purposes.